Imagine for a second that you're holding an Apple 200 strike call option.
Oh man, talk about stressful.
Right. I mean, it's 2 days before earnings. The stock is just swinging wildly. Your heart rate is spiking. And, you are literally sweating bullets.
Yeah, we've all been there, staring at the screen.
Exactly. You're staring at the options chain, trying to figure out if you should hold on or bail out. But all you're really looking at is a zigzagging price line on a chart.
Which is, frankly, terrifying.
It is. Trading options without indicators in a moment like that is, well, it's essentially like driving a car down a windy mountain pass at midnight with a completely broken dashboard.
Yeah, you have no idea how fast you're actually accelerating.
Right. And you certainly don't know if the engine is about to overheat.
Yeah.
So, welcome to the deep dive. Our mission today is to fix that broken dashboard.
That's a great way to put it.
We're pulling from a stack of sources to demystify two of the most heavily relied upon technical trading indicators, right? The RSI and the MACD.
Which are crucial if you're trading options regularly. You know the struggle of timing your entries.
Oh, absolutely. So we're going to break down how using these two tools together provides this, massive shortcut to filtering out market noise. We want to spot high probability trend reversals before the broader market even catches on.
Because, let's be real. In a market dominated by algorithmic trading and just total information overload, retail traders, you need a systematic way to process what's actually happening beneath the surface.
Yeah, otherwise you're just guessing.
Exactly.
Yeah.
When you just look at price action, you see a massive rally and assume it has to pull back. Making assumptions based purely on the visual steepness of a price chart is just an incredibly dangerous game when you're dealing with the leverage of options.
Totally. So by the end of this deep dive, you'll see how combining these specific metrics allows you to stop guessing. We are looking for the underlying physics of a stock's momentum, identifying exactly when institutional buying or selling pressure is mathematically exhausted.
It's about the math, yeah.
So let's start building this dashboard, because before we can even think about identifying a trend reversal, we first have to measure a stock speed.
Right, which brings us to our first gauge.
Yep, the RSI, or the Relative Strength Index. The sources describe this as a pure momentum thermometer. It oscillates on a scale from 0 to 100.
And it's basically comparing a stock's average gains to its average losses over a specific rolling period, which is, almost always set to 14 days.
Why 14 days, though? Is there a specific reason?
Well, yeah, the 14-day window is the industry standard because it provides a really solid rolling 2-week snapshot. It's constantly asking whether the buyers or the sellers have dominated and by what magnitude.
Okay, you got it.
So if a stock is posting consistent outsized gains, that thermometer pushes up toward 100. And if it's taking a beating day after day, it drops towards 0.
And if it's a tie?
If it's a perfectly even tug of war between the bulls and bears, the RSI hovers right around that 50 center line.
Right. So the critical thresholds our sources really emphasize are 70 and 30. If the RSI crosses above 70, the asset is tagged as overbought, which signals the upward momentum might be overextended.
Yeah.
And if it drops below 30, it's oversold, suggesting the selling pressure might be washed out.
I like to think of this mechanically,
So
if I'm driving a car up a really steep hill, I can pin the accelerator to the floor. The RPMs are going to redline. That's our RSI hitting 85.
right, the engine is screaming.
Exactly. The car's still moving uphill,
Mm.
but the engine is screaming. Eventually, it has to downshift or pull back before it can keep climbing. But if I just look at the tachometer hitting the red line and assume the car is going to instantly roll backward down the hill, I'm going to get run over.
That is such a good analogy because
Yeah.
that touches on a trap that just blows up countless trading accounts.
Oh, I bet.
There's this fundamental misunderstanding of what the indicator actually measures. The RSI measures momentum, not direction.
Momentum, not direction.
Right.
Yeah, so a stock experiencing extreme upward momentum will have its RSI pegged at 85 or 90. If you step in front of that trend and short the stock simply because the indicator says overbought, you are stepping in front of a freight train.
Ouch. Yeah.
Strong structural uptrends can remain severely overbought for weeks.
Okay, let's unpack this. So the engine is screaming, but the road is still pointing straight up.
Yeah.
I'm guessing that means a high RSI is a signal to consider taking profits off the table if you're already long, right? Rather than a signal to aggressively short the top.
That's the practical application exactly. An RSI of 80 tells you, hey, don't chase the stock by buying new calls at the top of the range.
Right. The easy money's already gone.
Exactly. It tells you the easy money on the upside has likely been made for that specific leg of the rally. but it is not an automatic standalone sell signal. Trading RSI in a vacuum creates false signals because momentum can decouple from the broader trend.
Okay, so because RSI can trap us in a relentless uptrend, we clearly can't just rely on the RPMs.
No, you need more data.
Right. We have to look at the structural health of the underlying trend itself to confirm what the speed is telling us. Which brings us to the second gauge on our dashboard,
The MACD.
the MACD, Moving Average Convergence Divergence. That is a mouthful.
It is, but it's brilliant. The MACD acts as a trend momentum hybrid. It takes the immediate speed of the price action and anchors it to the broader directional trend.
So it smooths things out.
Yeah, exactly. It prevents you from getting shaken out by a momentary blip in speed.
Okay, but the math behind the MACD can look pretty intimidating. The sources break it down into a few moving parts. You have the fast MACD line, right, which is calculated by taking the 12-period EMA and subtracting the 26-period EMA.
Wait, hold on. Let's make sure we define EMA for anyone listening.
Good point. So that's the exponential moving average. And just in plain language, it's a moving average that gives more mathematical weight to the most recent price action compared to older data.
Right. It cares more about what the stock did today than what it did 2 weeks ago.
Exactly. And then you have the slow signal line, which is a 9-period EMA of the MACD line itself. But, okay, let's translate that out of the textbook.
Let's use an analogy.
Yeah, I visualize the MACD line and the signal line as two runners in a long-distance race.
I like that.
The fast MACD runner reacts aggressively to what the stock is doing right now. The slow signal runner is a bit more sluggish. He represents the average pace of the trend over time.
That's a really clear way to picture it. Using two moving averages of different lengths creates this dynamic relationship. You're constantly comparing the short-term burst to the medium-term average.
Right. And the visual output of that relationship is the Mackey histogram. It's that series of vertical bars above and below a zero line that literally represents the physical distance between those two runners.
Yes.
So if our fast runner is accelerating and pulling away from the slow runner, that distance grows and the histogram bars get taller, bullish momentum is increasing.
But if our lead runner starts to get winded.
Exactly. If he gets winded and the slower runner starts closing the gap, the histogram shrinks.
And that shrinking histogram, that is the true leading indicator here. It visually proves that momentum is decelerating before the moving averages actually cross.
Oh, wow. So going back to the runners, you don't have to wait for the slower runner to physically overtake the fast runner to know the dynamic of the race has changed.
Nope. You can see the gap closing in real time. That shrinking histogram is your early warning system that the trend is running out of steam.
Which means I'm getting a heads up to prepare for a reversal before the broader market reacts to the actual moving average crossover.
With a significant caveat, though.
Uh-oh. What's the catch?
The MACD excels in clear trending environments. But in a choppy sideways market, those moving averages will constantly crisscross and generate false signals.
Right. It gets messy.
Yeah, it gets really messy. Even with the histogram shrinking, you still want to see that actual crossover confirmation before committing capital. If you jump the gun on a shrinking histogram alone, the fast runner might just catch a second wind.
And the trend resumes, leaving you trapped on the wrong side of the trade. Okay, so we have our momentum thermometer in the RSI, and we have our structural trend tracker in the MACD. The real edge in trading options isn't just looking at these indicators individually, right?
Chiefly not.
It's finding the moments when they completely disagree with the physical price in the stock.
You are looking for divergence. That is where the highest probability setups live.
Divergence. Okay, our sources define bullish divergence as the specific moment when a stock's price breaks down to make a new lower low, but the indicator makes a higher low.
Right.
Let's walk through the decision logic of a real-world scenario from the materials. Let's look at Apple, ticker AAPL. The stock took a massive beating, pulling back from $198 all the way down to $165. The price just made a brutal lower low.
Yeah, the candles are red, the chart looks terrifying, and retail traders are likely just panic selling.
So if you're trading purely on the visual sentiment of the price chart, you want nothing to do with Apple at $165. The psychology of the herd is telling you the stock is broken.
Right. But when we check our dashboard, a completely different narrative emerges.
Let's hear it.
Even though Apple's physical price hit a new lower low at 165, the RSI thermometer didn't drop as low as it did during the previous dip. It made a higher low.
That is a bullish divergence.
Exactly. So the chart looks like a disaster on the surface, but the underlying momentum is secretly recovering. The sellers are actually running out of shares to dump.
So the physical selling volume is no longer translating into downward momentum.
Yeah, and the rubber really meets the road when you take that RSI divergence and combine it with the MACD. This introduces the concept of confluence.
Confluence. So that's when multiple mathematically independent indicators all agree on the same narrative.
Got it.
The sources outline this ultimate bullish entry checklist for this exact Apple setup. I see 4 critical boxes that need to be checked. Let's run through them.
Go for it.
First, the physical price pulls back to a known macro support level, which gives us a logical area for a bounce.
Check.
Second, the RSI dips down into that 35 or 40 range, ideally displaying the higher low of a bullish divergence. Third, our MACD runners signal a shift. The histogram stops expanding negatively and begins shrinking back toward the zero line, confirming the selling pressure is exhausted.
Check.
And finally, we get the green light. The fast MACD line crosses up and over the slow signal line.
When you have confluence across price support, RSI divergence, and MACD crossover, you have filtered out the noise. You aren't catching a falling knife, you know. You're stepping in precisely when the math dictates the institutional sell program has finished.
Okay, let's talk about the actual trade here. In this source example, the trader waited for that exact checklist to hit, bought the Apple 170 strike calls, and those calls doubled in value over the next 6 weeks as the stock reversed and ran back up to 195.
A textbook trade.
But let's clarify the math for the listener. If I buy that 170 call, my break-even at expiration isn't just $170, right?
No, definitely not. Your break-even at expiration is your strike price plus whatever premium you paid for the contract.
Right, so if I paid $5 for the option, Apple needs to hit 175 just for me to break even at expiration.
Exactly, but your payoff at expiration is theoretically infinite on the upside. Once it clears that break-even, it's pure profit.
Right. But what stands out to me in the sources is that they didn't just blindly buy short-term weekly options. They bought options that allowed the trade time to develop. Like, if we spot an incredibly pristine setup like this, bullish divergence, MACD cross major support, the temptation is to just grab zero-day options to maximize the leverage.
Well, that's a classic mistake.
Yeah, but the sources mandate buying options with 30 to 45 days to expiration. Why give the trade that much runway if the indicators are telling us the reversal is imminent?
Well, that touches on the realities of institutional capital flow versus, retail expectations.
Okay, explain it.
Reversals in large-cap stocks like Apple are rarely instantaneous V-shaped bounces. When hedge funds and institutions unwind short positions and begin accumulating long positions, they don't do it all in 5 minutes at the opening bell.
Right, they'd move the market too much.
Exactly. They scale in slowly over days or weeks to avoid spiking the price on themselves.
So if I buy an option expiring this Friday, I might have the direction 100% correct, but I'm going to get crushed by theta burn while the institutions take their time turning the ship around.
Exactly. And let's use a quick analogy for theta, just so we're clear. Theta is one of the Greeks.
The Greeks, right. Plain language only, remember?
Right. Think of theta like paying for a parking meter. Holding a short-term options contract is like paying for a parking meter with only 5 minutes on it while you wait for a notoriously slow elevator.
That's good.
It doesn't matter if you are eventually going to reach the penthouse, right? The meter runs out and you get a ticket before you even leave the lobby.
Wow. Okay. So by utilizing 30 to 45 days to expiration, you're paying a slightly higher premium to absorb that theta decay. You give yourself the staying power to sit through the messy, choppy bottoming process without watching your contract bleed out.
It's all about risk management. The sources also mention targeting at the money or slightly out of the money strikes for these setups.
Right. You don't want to buy a call so far out of the money that Apple would have to rally 20% in 3 weeks just for your option to gain intrinsic value.
Nope. You want a realistic strike that benefits immediately when the delta starts expanding.
Okay. But what if the strategy fails? Because confluence provides a high probability entry, but probability is not certainty.
That's a vital point. The strategy relies on strict invalidation rules.
Right, because if I check all the boxes, buy the Apple 170 calls, and the stock just rolls over and breaks the 165 support level, I need an exit plan.
Yeah, the thesis is entirely predicated on momentum following through.
Wow.
The moment the RSI drops and makes a new lower low destroying the bullish divergence, the setup is dead. The moment the physical price breaks and closes below that critical support level, the setup is dead. You do not hold and hope.
No diamond hands here.
Absolutely not. You lose the premium if you ride it to zero. So you close the contract, take the controlled loss, and preserve your capital for the next confluence setup.
Okay, let's shift gears and look at the inverse of the Apple trade. Our sources provide a blueprint for overbought fade plays, using Tesla as the primary example.
Oh, Tesla. Always a wild one.
Right. Tesla goes on an absolute tear, rallying from $180 straight up to $290. It is a massive, seemingly unstoppable uptrend, but the dashboard is flashing bright red. The RSI thermometer hits a staggering 85.
Remember our car driving up the steep hill. The RPMs are redlining at 85. The engine is screaming.
But as we established earlier, we don't just short it because the RSI is at 85. We wait for the MACD to confirm the engine is actually failing.
Exactly.
In the Tesla example, while the price is hovering near 290, the MACD histogram stops growing and starts shrinking back toward the zero line. The distance between the fast and slow runners is closing.
The buying momentum is quietly exhausting itself even while the stock sits at the highs. You have extreme overextension meeting a confirmed loss of momentum. It's the exact inverse of the Apple setup.
So the institutional buying has dried up.
Yeah, and profit-taking is beginning to outweigh new capital inflows. The source notes that over the next month, Tesla pulled back 20%, and traders who utilize put spreads saw their contracts triple in value.
Wait, I find it really interesting that they specify put spreads rather than just naked puts for an overbought fade.
Well, what changes my ticker here?
Right, the implied volatility. A put spread involves buying a put option while simultaneously selling a put option at a lower strike price. It caps your maximum profit, but it significantly reduces the upfront cost of the trade.
And with Tesla.
Exactly. Tesla's trading at highly elevated implied volatility levels because of that massive run-up. Buying naked puts would be astronomically expensive. By using a spread, you're neutralizing some of that volatility crush when the stock finally cools off.
That is a highly sophisticated approach to risk. Panic selling in an oversold market is often violent and fast, which spikes volatility. But an overbought market can sometimes just bleed out slowly as buyers lose interest. A put spread protects you if the stock decides to just chop sideways for 3 weeks before finally dropping.
Okay, so the sources outline two other vital strategies that complete the playbook. We've talked about catching reversals with divergence, but what about momentum continuation?
Yeah.
What if we're in a strong bull market and we don't want to fade the trend, but we also don't want to buy the absolute top?
Well, the RSI isn't just for extremes. The 50 center line of the RSI is incredibly useful for continuation plays.
How so?
In a structurally sound uptrend, you'll see the RSI push up into the 60s or 70s, right? And then the stock pulls back for a few days, the RSI drops and tags the 50 line.
And since 50 represents a perfect equilibrium between buyers and sellers over the last 14 days, it basically acts as a momentum support level.
Exactly. If the RSI bounces off the 50 center line and curls back up, while simultaneously your MACD fast line crosses back above the signal line,
Boom.
yeah, you have a high probability entry to buy the dip. You're riding the primary trend, but you're utilizing the indicators to ensure you enter the trade precisely when the temporary pullback is over.
Okay, that perfectly frames the oversold bounce play as well. If a stock is in a free fall and the RSI crashes down to 20, we don't just blindly buy the dip because it's quote-unquote cheap.
Never.
We wait for the MACD histogram to stop expanding negatively. We wait for the selling volume to prove it has exhausted itself. And we wait for the moving average crossover to give us the mathematical green light that the institutional tide has turned.
The overarching theme across all four of these strategies, divergence, overbought fades, momentum continuation, and oversold bounces, is that you are outsourcing your trade execution to the math. You're removing human panic and human greed from the equation.
Let's bring all of this together. We've built out a complete dashboard today.
Yes, we have.
We started with the RSI, our momentum thermometer. It gives us the immediate speed and tension of an asset, oscillating between 0 and 100.
Right.
But we established the golden rule. Momentum is not direction.
Right. An overbought RSI isn't a standalone short, and an oversold RSI isn't a standalone buy. You have to pair it with structural confirmation.
So we layered on the MACD, our trend momentum hybrid. We utilized the histogram to watch the distance between our two moving average runners, giving us a leading visual cue that momentum was quietly building or dying well before the actual price reacted.
It's like seeing the future, almost.
And finally, we looked for confluence. We waited for those rare moments of divergence, like Apple making a lower low in price but a higher low in RSI, and used the MACD crossover as our definitive trigger to enter a well-calculated options trade, and utilizing 30 to 45 days to expiration to ensure we survive the theta decay.
By waiting for confluence, you transition from reactive trading to predictive execution. You look past the noisy, emotional price action on the surface and operate based on the underlying mechanical exhaustion of the buyers or sellers.
It really is like finally fixing the dashboard on your car. You can see your speed, you can monitor the health of your engine, and you can actually navigate the hairpin turns of the market without driving off a cliff.
It's huge. And, I'll leave you with a final thought to ponder as it raises a question about the nature of edge in the modern market.
Okay, let's hear it.
If millions of retail traders and institutional algorithms all around the world are looking at the exact same 14-day RSI calculations, and they are all watching for the exact same MACD crossovers to execute their trades,
Yeah.
does a trader's real edge actually come from the mathematical formula of the indicators? Or does the true edge simply come from having the psychological discipline to sit on your hands and wait for perfect confluence while the rest of the market impatiently jumps the gun?
Wow. That is the million-dollar question right there.
Mm-mm.
It implies that the dashboard works perfectly, but the differentiator is still the patience of the driver.
Exactly.
Like next time you're staring at an options chain, your heart is pounding and the market is swinging wildly. Don't drive in the dark. Check your dashboard. Wait for confluence. Thanks for joining us on this deep dive. Go analyze those charts, look for the divergences, and we'll catch you on the next one.